Hi there. Welcome. My name is Nathan Krampe for Lions Wealth Management. What an interesting year this has been. Now, that's kind of an understatement. I'm very aware of that. I mean, we've had a lot going on with respect to the pandemic and how that's really changed our lives. Well, what I want to talk about today is the economy, the stock market, and then ultimately where we're going from here so that you can help position yourself in your portfolio correctly going forward. Well, there's, like I said, a lot that's been happening this year. We've had a hurricane, we've had the pandemic, we have had some very, very horrific changes to the class system, the socioeconomic class system, with respect to a lot of people being out of work, unemployed, and that's led to some social unrest, some rioting that's happened. So this has been a very, very interesting year. Well, one of the things that I really kind of noticed right away was that I was trying to go and get a bike for my son. It was his birthday and I wanted to buy him a bigger bike, and really, there are no bikes to be had. There are no bikes in the bike shops. Really, ones that are being sold online as used are really either no good or completely overpriced. And so it's been very hard to find even just normal things in our lives, whether it's a bike or whether it's toilet paper or anything else that we have. What we're seeing is that there's a lot of kind of changes that have been happening. So let's dive in. I want to talk about this, and I want to actually talk about it in light of the kind of the pandemic and kind of going through some of the ways that you are seeing the vaccine trials happen. So the vaccine trials really come down to kind of different phases. You have the first clinical phase and the trial phase, and that is just a very, very small grouping, and that's usually maybe 4, 6, 10 people, something of that manner. And it's just a way for the companies to learn if the drug is even going to be worth it to consider moving forward. Now, if that's successful, then they go to phase 2, and that's a broader sample size. That's something that they can have a lot more people involved in, but it's still not that big. Now, phase 3 is really where it really starts to take off. And if you have phase 3, that means you're giving it to a broad number of people, and most likely this is going to be a very good candidate for a vaccine. Now, lastly, you have phase 4, and the phase that's basically taking into account what you've already done and kind of going back and saying, so what? What have we learned? What can we improve upon? And are there some very small minor changes that need to happen before we go and get FDA approval? Well, there's many drugs that are in phase 3 studies right now, and that is incredibly good news when it comes to just kind of moving on from this pandemic. So that is kind of in light with the pandemic, and you're seeing that all over the place, that we have now some good news with respect to the number of cases, the number of hospitalizations, and the number of deaths all going down. Well, around the world, we have kind of a flattening of the curve, and that's very, very good news for kind of getting back to life normally as we see it. Okay, now let's take that same analogy with respect to the phases, and let's use that to the economy. Phase 1, I would say, would be the lockdown or the closure of our economy. And we had a very, very hard time, and that went from growth in our economy to a depression virtually overnight. So we went from phase 1 to phase 2, and the phase 2 was the reopening. That was really saying, all right, now we're moving forward. Now we're starting to get back to normal, and we're starting to hopefully kind of move past this. Well, that is phase 3 that we move into now. So phase 2 is the reopening. Phase 3 then is kind of the broadening of that reopening. So remember, if we go back to the clinical trials of a vaccine, phase 2 is a smaller subset. So I would say the reopening of our economy was a kind of a smaller deal. We knew there was going to be some rebounding growth, but now phase 3 is really where it comes to saying, are we going to have sustained growth? Well, we're starting to see a lot more growth happening just in our economy with respect to even how we travel. all of us are driving more today than we were just even a couple months ago. And when you take a look at how much we're driving, we're actually driving the same amount we're doing today as what we were prior to the pandemic. So phase 3 is somewhat decent in saying that we're starting to reopen our economy and we're starting to travel a lot more. Well, obviously we're not going to work. We're not driving into work because most of us are working from home, but many of us are going out and traveling a lot more. And this is kind of graphs showing not only Apple Maps, but Google Maps and some of our usages and traveling that we're doing. And it's really showing that we're getting back there. So we have had a very, very good phase 2 reopening. So let's talk about phase 3 and where we're going from here. Well, there's going to be 3 key areas that I want to talk about today. First one is going to be the US dollar. Second one is going to be commodities. And lastly, we're going to be talking about gold, everyone's favorite. Well, then at the end, I'll kind of sum it up as to the next step of our economy and what that means for you. Okay, let's dive in. Let's start with the dollar. Well, this is kind of a fun picture that I have here saying it's the bull in the middle. And remember, if you're going back to the stock market, bullishness, bulls in general mean that we're kind of growing in the stock market. Bearishness means that we're very, very negative or we're going down in the stock market. And what this is saying is that basically we're all tied. The stock market is tied to the dollar. And that's been something that we have been seeing more and more in this kind of what you call correlation is becoming ever more kind of compressed and extreme. And what I mean by that is sometimes things are all over the place. That we can have something happening to the dollar, something happening to the stock market, something happening to the bond market, and they don't mean very much. They're not really correlated. Well, now, right now, we are having almost a 1-to-1 inverse correlation. So every time we have a change in the US dollar, whether up or down, the stock market is going to do the opposite. The bond market may do the opposite. The commodities may do the opposite. And even gold may do the opposite. So knowing where the dollar is going to be very, very imperative to knowing where the future of not only the stock market, but all these other things are going to go. Because, like I said, it's going to be really, really inversely correlated. So let's take a look at that. Where are we going with the dollar? Well, unfortunately, we're going down. Now, I say unfortunately because that does mean a lot of things here as to what expectations are. And it's really because there's been a lot coming out with respect to inflation and what the Federal Reserve is trying to do to pump our economy up. You see, what is really going on here is that we have had a lot of money being plowed into the stock market from the Federal Reserve in many, many different fashions. And that has really started boosting the stock market, boosting the bond market. And what they're also doing right on the heels of kind of what we're coming into the election is we're devaluing the dollar. Now, why is that important? Why is devaluing the dollar important to us? Well, it really comes to the fact that when we have a devalued dollar, it means that our currency is worth less. Well, that helps out manufacturing and exports, something that as a political candidate you would want. Because if we can export more goods, we need to hopefully hire more people to do that, to make those goods, and that leads to jobs. So having a devalued dollar hopefully will help exports, and then the jobs can become a part of that. Well, that's the good aspect of it. There's other sides of the story too. When you take a look at how many people have been laid off, and there have been an exorbitant amount of people that have been laid off and claimed unemployment benefits in one way, shape, or form since March. And right now, at the low end of the unemployment claims, we're still doing about 1 million people that are getting unemployed benefits new people claiming unemployment benefits on a weekly basis. And this is kind of horrific because when we take a look at how many people are being laid off and who are being laid off, well, unfortunately, it's more of the lower income earners are the ones that are suffering the most, and the ones that had the least amount of money set aside to kind of weather the storms. So there's some very bad news that comes with this. And when we talk about a devalued dollar, that means that our money is worth worth less today than yesterday. So it's worth less today than yesterday. Now, when we couple that with some of the other things that we're starting to see, with inflation starting to happen, now you can also start seeing a little bit more of the fact that if we have our money being worth less and the cost of goods that we're purchasing going up, that can be a very precarious situation here. So the Federal Reserve is really trying to work correctly to kind of navigate this, but ultimately what they're saying is that if we can export more goods, if we can kind of put America first, and I'm not making a political statement for one candidate or another here, but as we're trying to put America first and trying to just export more goods to other countries, that will in turn will basically hopefully get jobs there. So it's something to be looking at. Now, when we take a look at how much debt we're taking on to do this, it's becoming exorbitant. And right now, the Federal Reserve is continuing to keep pumping money into the system to try to keep this going. And we've had stimulus packages from Congress, and we're even contemplating another stimulus package. Well, that's contemplating right now because I think they're kind of worlds apart on negotiation standpoint. But when you take a look at this, basically what this chart says is that we have a lot going on with respect to taking on debt. And the Federal Reserve, and especially Jay Powell, our chairman of the Federal Reserve, has come out and said, we're not going to worry about that at all right now. We're going to take on as much debt as we need to get our economy going. Well, for right or for wrong. But what that also does then is say, well, if we're going to be taking on more debt, if we're going to be doing all these things in order to make this happen, well, at some point in time, inflation is going to start happening. Now, last week we had Jay Powell speak as part of the Jackson Hole Summit, and usually they have this, in person, but this case it was a little bit virtual. So, it is what it is for this year, going back to what an interesting year this has been. But as a whole, what he has said is that yes, we know inflation is starting to creep up. No, we're not worried about it. You see, right now we're kind of coming back up to where they want our target to be at about 2%. But what Jay Powell said at Jackson Hole is that 2% used to be our target, meaning we're going to keep it trying to be right around 2% at all times for inflation. And that's a good thing. So that actually is helpful for our economy. But now what he said is that, well, you know what, that's going to just be kind of like an average. And more to the point, he thinks we're going to start going above 2%. And again, he's okay with that. So, well, if we have the devalued dollar, meaning our dollars are worth less today than they were yesterday, and inflation's happening in the cost of goods, well, that's kind of a recipe again for saying that some of the lower class are going to get hurt the most, and even you are going to need to kind of take a look at how you can protect the value of your money. Because really, we're pumping a lot of money into the system. So this is the dollar index over time, and it really does show that we potentially have ways further that we could devalue the dollar, just even in respect to history. So there's a lot to be considering with that. Now, going back to what I said, if we're devaluing the dollar and we are inversely correlated to a lot of different assets, there's a lot of room for some of these assets to grow. So we're pumping a lot of money into the system. And what do we go into when we have a devalued dollar and we have inflation? Well, there's a lot to look into. The stock market is one of them, but there are commodities. That's our second point. Commodities is going to be a great place to be invested. So let's take a look at this. Whether it is everything that you find in the grocery store, agricultural things as well, soybeans, corn, you have cattle, cows, beef, I mean, all of that. You have wheat, cocoa. I'm sure you probably drink coffee. Coffee is going there too. All of these agricultural goods are becoming more and more expensive because of inflation. Well, that's also something that's really starting to take off more and more. So let's kind of dive into the thought and kind of where we go from here. Well, we've talked about agriculture, we've talked about some other things there, and some of that's supply chain issues, but a lot of it is because of the fact that we have a lot of demand, because really, we're not going to the restaurants as much as we were. Yes, we may be driving as much, but we're not going to restaurants nearly as much. So we're cooking more at home, meaning we have kind of a change in habits of what we're eating, and a lot of those products are becoming more and more expensive. Well, what else is becoming more expensive? Gasoline. Well, if we're driving the same or more today than we were even prior to the pandemic, gasoline's going up. And when we take a look at what has happened, I mean, we had just this massive kind of lockdown of our country and no one was driving anywhere. I can still remember seeing absolutely no cars on the street. In the middle of the night around my neighborhood, there was not a single sound of the highway or anything. And that's kind of an eerie place to be. And so much so, we were driving so little that there was such an abundance of supply of oil that at one point in time, a barrel of oil was not just worth nothing, it was worth negative $20, negative $30, negative $40. And what that means is that if I had a barrel of oil that I wanted to sell to you, you didn't want it, so much so that I would have to pay you $40 for that barrel of oil for you to take it off my hands. That's where we were just a couple of months ago. But we're moving past that. We have come back in demand. Things are getting back to normal with respect to driving. So now, obviously, oil prices are going up, and that's leading to higher gasoline prices. Well, gas is a big deal when it comes to inflation. So we have inflation happening in gasoline. We have inflation happening in anything from agricultural goods to copper to precious metals. All of those things are going up in value. And that's because of the demand, but also is because of not as much supply either. Well, going back to the bike that I was trying to find for my son, it was higher priced inflation than what it should have been just because there was such a high demand. So you're going to start seeing these things happening more and more. That some goods are going to be a lot cheaper because there's no demand for them. Other goods are going to start to be more and more expensive because there's such a high demand, and our supply chains, even though we're getting back online, aren't quite there yet. So just be aware of that. But let's go back to the cars. Why is it that we're driving more? Well, one part is that we're going to a lot more places, but we're not exactly going to work. We're working from home. So one of the things that are not doing very well are subway systems. You can see from this that subways around the country, and this one is highlighting New York City in particular, which I totally agree. Not as many people are going into New York City as what they once were, but think about it another way too. Subways are not a great way to social distance. What is one of the best ways to social distance? Your car. So you're seeing car sales go up. You're starting to see more and more of us driving versus taking public transit. So there's going to be a change in pattern. And again, that can lead to inflation in some many areas there. So just kind of keep that in mind. What else? Well, we also have jet fuel. You see, we are really nowhere near where we were in flying, but we're getting back to that. So we're about a third of the way there with respect to how many people on a national basis are going through the TSA checkpoints. So we're definitely getting there, but on the same standpoint, that means more flights are happening. That means what used to be costing a lot less for that flight is now costing more today because of the fact that the price for jet fuel is going up as well. So we have oil prices, we have jet fuel, we have agricultural goods, we have even the John Deere tractors or tractor supplies, we have Caterpillar, all the heavy equipment manufacturers are selling their products for more because they're actually in demand, which is kind of a weird place to be in the middle of one of the worst kind of depressions, not just a recession, but depressions that we've been in since the Great Depression. Well, that's kind of, again, something interesting. And when you talk about kind of all the other things that we're seeing here, you can take a look at different commodities. Lumber is just this weird kind of massive run-up that has happened in the price of lumber, and that's really because of the fact that we've had, well, a lot of home building that's happening. You see, people don't necessarily want to be in an apartment. It's kind of the thought process when there's a pandemic. So there's a lot of movement happening out of apartments, inner city, to kind of the exurbs, the very, very far out suburbs, where they're needing to buy houses or even build new houses. So you have the price of lumber going up, and with the lockdowns, obviously there was really no lumber being produced and milled at that point. So we have this perfect storm of saying we have a very, very low supply and a massive amount of demand. So, well, that means that obviously lumber prices are going up. And then couple that with the riots that have been happening and the need for more boards to go on, whether it's the windows or even rebuilding from damage to things like the hurricane. Well, I mean, Texas and Louisiana have been hit severely, and they're going to need to rebuild, which means lumber is going to be in demand at a very, very high pace comparatively to where it was, which means, obviously, inflation. So that's just something to know, that inflation is coming, and all of that comes back to commodities and where we're going. That's a great place to be invested into as we're going through this point in time. So we have the dollar is going down. That's driving in itself some of the inflation that's happening with some of the commodities, but it's also the demand. We have low supply, higher demand, and that's changing things around here as well. Well, what can we do about this when we have inflation, we have a low dollar? That is a very, very good way to say we should have gold as well. You see, when we're talking about gold, gold is one of those things that really is kind of a hedge against inflation. So that may be a great place to be going forward. And when we take a look at where the Federal Reserve is trying to get things, you know, they're trying to really devalue the dollar, but they're also doing that by how they're purchasing more and more bonds. So when you take a look at all these things together, bonds have been one of those things that, historically speaking, has been actually a decent place to be invested. Now, I say a decent place. The federal government is backing the bonds that they issue. So that's actually you that's backing those bonds. Because when we issue a bond from our federal government, you as a taxpayer are on the hook to basically pay for that bond. So the full faith and force of the tax-paying citizens are the ones that are backing these bonds. So they've always been a historically great place to be invested. The problem now is not that you're not backing them, because you still are, but the problem now is that they're not paying a lot of interest. So if you buy a bond from our federal government, you're not getting a lot of interest. So, well, people start shifting of where they want to be invested. No longer are they going to be buying that bond in the same way. So the other asset classes that do really well are sometimes stocks and sometimes gold. Well, this is kind of becoming a perfect storm now for gold, because we have the inflation happening, we have a devalued dollar, and people need to find an alternative so that their money is still worth something in the future. That's where gold steps in. That's where gold miners step in. The ways that we are mining and the companies that are mining gold for the future. You see, when we have a higher gold price because of inflation and a devalued dollar, well, they actually earn more. So they have more revenue that's happening. Well, what else happens then? Well, over the last couple of years, I'd say couple more like part of the past decade, automation has kicked in a lot more. You have a lot more paying down of debt of a lot of these corporations, and you have a lot less overhead of employees. And what that means is their costs are going down. So you have a higher revenue from the price of gold and a lower cost. That again is going to be this just kind of perfect storm of the reason why the companies that mine gold could be a great place to be invested going forward. So gold is there, the companies that mine gold, all of these can be a great place to be. And when you've taken a look at where we've been just recently, we've had a huge run up in the price of gold. And there are many that are saying that we're not done yet. Going back to our chart, when we take a look at it, of where we are inversely correlated, we are almost 1-to-1 negatively correlated to the dollar. If the dollar is going down, that's a very good reason to say that most likely gold prices could go up. So when we take a look at that, going back to inflation, like I said, this is the big deal. This is why I keep coming back to the inflation part, is because when we have the bonds that are not paying much, we have high inflation. That really means right now is that we need to find the alternatives, and gold can be those alternatives. Jay Powell has come out. He's already said this. Like I said, at Jackson Hole, he basically said no matter what, they're going to continue to try to work to devalue the dollar, create more inflation, so that we can try to get our economy back going, so that we have the ability to hire more people and get our companies back in line. Well, that's really something that means we can be going into the stock market, but there's going to be some great places to be going forward. Well, yes, I say great places to be growing, but it also comes back to where are we going with the virus? And when we take a look at the virus, yes, we have the ability to have a resurgence here. That's very, very possible. And this is a great place to look. This is called the R0 kind of transmission rate. And what this shows is anything above 1 for an R0 means we are more transmittable for the virus than if we are below 1. And this shows every state in our country and where we're at. So there are some states that are above that R0 of 1, and meaning that there's a higher level of transmittability of the virus. And right now, there's a lot of states that are below that level. So it doesn't mean that we're not transmitting it and getting it, it's not growing, but it does mean that it's a lot harder and not as fast to be spread. Well, that's also something to be considering as we go forward, because when we take a look at where we're at with the virus, when we take a look at where we're at with our economy, the more we can continue to keep growing the economy, the better. Once we can start doing that, well, then we no longer need to really be suppressing the bonds in the way they are. So more likely that we'll have kind of a sell-off in bonds, because, well, we don't need the risk hedge anymore because our economy is doing a little bit better. So that could start to change here in the future as well. But it all comes back down to the virus. It all comes back down to how our economy is growing. And it comes back to our federal chair, Jay Powell, and his thought process. So keep your eye on all of those going forward. But remember, if our dollar is moving up or down, we are having kind of an inverse correlation happening here with not only the stock market and commodities and gold. So, what does this all mean? Unfortunately, some of the news is not that great that's coming out. We had a good phase 2 reopening off of our phase 1 closing of our economy. But phase 3 is what we're in. Basically, this is trying to be that recovery process here. So we went from reopen to recovery, and that's not going as well as what we had anticipated. And what that means is stagflation. We have a stagnant economy, but we have inflation that's happening. Well, that's something that we need to be taking a look at more and more with the stock market and what that means here as well. Take a look at that chart. What I'm showing here is a chart of a stock. And this is a stock that's going down in price. Now, when you have professionals that are taking a look at this, they would take a look and say, well, I can make money on the stock going up, and I can make money on the stock going down. Which should I do in this particular case with this particular stock? Now, most professionals look at this and say, it's very, very likely that it's going to stop going down. Maybe it'll start kind of what you call rebounding, kind of getting back a little bit to an average price and a little bit more normal of a price. You see, stocks don't always go down all the time, and stocks don't always go up all the time. And so you would see this stock kind of start rebounding here, and so many traders would start saying, all right, well, let's start betting on this stock to go up. Well, I'm kind of fooling you here because this is just the chart of Apple flipped. So really, if we flip this chart around, this is actually showing where Apple is at today. And Apple's just had this just historic run up in the price. And you're seeing this with not only Apple, but you're seeing this with Amazon and Microsoft and Facebook and Tesla. Now, I actually got the nice ability to drive a Tesla about a year ago, and it's a fantastic car. I mean, I was shocked by how well it not only operates, but the fact that I can be going down the highway at 70 miles an hour, I can be talking to the person next to me, my hands are not on the steering wheel, my feet are not on the gas, the car is automatically going to control how far it is behind the car in front of me, so it's going to adjust the speed, and it's going to keep me in the lane. But even more so, let's say I just want to move over a lane, I can put the blinker on, and the car is automatically going to move over that lane. It is a fantastic car. Now, they sell many, many thousands of these on a quarterly and a yearly basis. So they're doing quite well with the sales, and that's what Wall Street is loving. Well, you can take a look at Tesla, the share price that's happening, and if you equate that to where they should be and how many cars that they should be selling to match where the share price is today, they shouldn't be selling many, many thousands of cars. They need to sell 220 million cars on a yearly basis just to get the number of cars to catch up to the revenues of where the stock market is. Well, that means that we're having some kind of what you call bubbles forming, and it's actually showing in the fact that we are going to be very, very greedy in the stock market right now today. And that doesn't always mean we're going to be just having a collapse in the stock market, but that also means that we're starting to get to a point where maybe a pullback is expected. I don't know. I'm not saying that we're going to have one, but when you take a look at the economy, we take a look at where we are, we take a look at the number of households that have lost income. Not a lot of these households can afford to buy a Tesla. Not a lot of these households can afford to buy a new cell phone from Apple either. And when we take a look at where we are at today, we are actually seeing that 1/2 of American households have experienced an income loss since this virus has started. And that's, again, a horrific amount of kind of loss to people's livelihoods there. And when we take a look at their confidence, what we call the consumer confidence and how confident they are in the future, we are at a lower level today than where we were just back in March, April, May. That is really telling. It really is. Because when we had the closure, yes, I can understand how confidence would have gone down. But the reopening process, our phase 2, should have taken care of that. We should have actually been a lot more kind of jubilant of where we're going. But that's not what we're seeing. What we're seeing is people are starting to get less and less confident. But the stock market is really starting to go up more and more. Well, there's some reasons behind that, but when we start taking a look at small businesses and the revenues that they're seeing, you can take a look at this chart and it shows that we had a good reopening, yes, but the revenues in small businesses are starting to go down and revert. That's not a really good phase 3 kind of now recovery process. And when we couple that with where we have been, small businesses are now going down in the revenue, but our expenditures have remained about constant. I would kind of contribute that to the fact that we had the $600 stimulus on a weekly basis, the above and beyond amounts for unemployment. That helped. But what do we know? That is no longer. Well, Congress came out and they're trying to get a package deal done, so, well, they didn't. So the president came in and he started to say, all right, well, we'll give you $300 on the federal level, and then the state will have to kind of go in and use up some of their money and provide an extra $100 to give $400 a week to you as an employment. So we went from $600 a week to $400 a week. But here's the thing. The president can't authorize this the way that Congress can. So what the president had to do is just kind of reuse money that was designated in other areas. Well, where did he take from? Unfortunately, it was from FEMA. Now, there's good reasons why he did that. And like I said, this is not a political side one way or another, but there's good reasons why he did that. And obviously this is a good use of some FEMA money. However, we just had and are finalizing and finishing up a hurricane. We need some of that FEMA money. We need that to continue. And so the $300 most likely is not going to be there. I think the coffers are going to run dry on FEMA very, very quickly. And so the income that we've been receiving as unemployment benefits are going down and going away. So I don't expect us to be spending as much as we were just even a couple months ago. And when you couple that with apparel, when you couple that with anything from groceries starting to kind of come down a little bit, but, well, we're not spending money on restaurants either. So the leisure, the travel, the restaurants, all those things, we're not spending money on. And what we were spending is starting to come back. So all that is to be said that we're not growing our economy the way that we were, and there's a real likelihood, and we're starting to see it happen, that we're going to have what's called a double dip recession. Meaning we had kind of the come down, we had this come up, so the recovery phase, but the economy may actually start going back down as part of our phase 3 kind of recovery process that's not quite there. So phase 3 is going to lead into phase 4, which is going to be a continuation of a very, very depressed economy. And we did not go from a depression in our economy to a recovery. We've gone from a depression into a very, very massive recession. And some of us are feeling this more than others. But when we come back to the so what, inflation is happening. We're starting to see that in energy prices and all the different things. We're starting to see that in what we call our core CPI, our core inflation kind of index. That's coming back up because inflation is happening in many of our products. And the more inflation happens, the more goods are going to be costing more tomorrow than they are today. The less the money is going to be able to be spent because the dollar is being devalued. So it's going to be a perfect storm to say that we're going to be able to spend even less in the future. And we take a look at how many layoffs are becoming permanent. That's getting to be a staggering number. So companies aren't rehiring in the same way. And there's an expectation that people are going to be laid off more and more going forward. So this is not kind of forward looking and saying that people are going to be more and more fearful for their job. So when we couple being fearful for your job, lower spending, we've had this massive increase in our federal deficit that has led to all of these things happening with respect to the inflation, the devaluing of the dollar, and trying to make trade work, well, in which, like I said, is a good thing, but that comes back to the last point, that our depression that we've had is not going to equal a recovery. Phase 2 recovery process of our economy, going to phase 3, is not going to be a continuation and a broadening of that. It's going to be a stagnation of that. And I expect us to be in kind of a stagnant level for a little while longer, which means we're going to need to find great opportunities to invest money. And a lot of them are going to come back to a lot of the places that are going to be growing with inflation. Commodities are a great place to be. Energy is a great place to be, as well as gold. So those are just some thought processes. I want to thank you for your time today. And as you have questions, there's a lot here that we've covered. There's a lot that I've gone through, and I would love to talk through that a little bit more with you and give you a second opinion on your portfolio as well. So give me a call. I'd be happy to talk with that and kind of implications of what's going forward. So again, thanks for watching. Have a great afternoon. Take care.